We have 450 seats in the room and 50 people, so that's great. And thank you everyone for attending this morning. We have a great panel. I'm going to let each person introduce themselves. What I'm not going to do is spend half an hour talking about each of our organisations, but hopefully just dive straight into the debate. Now, I would, as much as possible, like to encourage questions and engagement in the dialogue as we go through the next 45 minutes to an hour. So please just stick your hand up or interject into the discussion. So hotels as an asset class versus other real estate asset classes. This is not a session that 8 years ago, maybe even 5 years ago, one would have been having. And I think many who are not familiar with hotels are quite surprised by the strong performance of hotels as an asset class. And we benefit today from a contrasting range of perspectives across the panel. I'm Simon Oaten. I'm a partner at Deloitte in the Travel, Hospitality and Leisure practice. And we have Mark, Navneet, Fabio and Renaud on the panel today. I'll let each of them introduce themselves now and ask them just to start with their perspective on hotels as an asset class and why it is of importance and interest to them, and then we will dive straight into the debate. Thank you. Navneet?
Short introduction.
Yep.
Navneet Bali. I am the CEO of a company called Meininger Hotels. It's a very specialized hotel company which focuses on, it's a hybrid between a hotel and a hostel. So it's a hotel with a hostel embedded in it. So you have rooms as well as regular hotel rooms as well as multi-bedded rooms, which you'd find in a hostel, all with ensuite bathrooms. So effectively, we deal with a large customer base. So we compete with hostels for student groups and student travelers, as well as for family groups, and also with hotels when it comes to business people and other individual travelers. So it's a wide range of customers that we cater to, and possibly a unique product. We have 16 hotels, 2,000 rooms across Europe. And it's quite an interesting session for me, and we can talk about that later, because it's because of the kind of product it is. It lends itself to conversions of offices, conversions of other asset classes. For example, our latest hotel in Brussels, which we opened last year, was a brewery converted to a hotel. So it's, we see a lot of asset classes which we can convert to hotels, and it'll be interesting to discuss why people are interested in doing that. And I think we can discuss that later.
Mark?
Hey, I'm Mark Clayton-Jones. I'm head of index research at IPD, which is a company which tracks the financial performance, the investment performance of real estate. So I'm maybe perhaps a bit more of the odd one out in the room in that I am not a hotel expert, but we have been seeing hotels coming into view for institutional investors in the real estate space quite a lot recently across the areas that we cover. So we cover tracking investment performance across 32 countries where real estate is most transparent, and real estate is not a very transparent asset class, but we're hoping to do something about that. We've recently been bought by MSCI, who do financial benchmarking, equity benchmarking particularly. So we're hoping to be able to bring a bit more transparency to those real estate markets globally that we currently don't cover.
Good morning. I'm Renaud Jezekel. I'm in charge of asset restructuring for Accor at corporate level. Some of you, maybe most, if not all, have probably read that we have kind of restructured Accor since Sébastien Bazin's arrival at our company as a new CEO in August. So we have a service business called Hotel Services and a investor developer business called Hotel Invest. Hotel Invest is in charge of running and managing 1,400 of our 3,600 hotels, and we want to, so out of those 1,400 we have under management, 300 of that we own, and the rest are under fixed or variable leases. And I'm in charge of effectively re-looking at the ownership structure of those hotels, the performance of those hotels, and possibly rehashing our asset and ownership management strategy going forward. So we'll be trying to debate as to whether it's a good hotels, as we talked about, is a good investment opportunity or not. And at Accor, we are obviously convinced that it is.
Good morning, everybody. My name is Fabio Longo. I'm Executive Vice President at Sanctity. Most of you will ask who is Sanctity, so let's just break the ice and tell you who Sanctity is. We are the credit affiliate of Bain Capital. Bain Capital is a large private equity firm. We are an avid buyer of credit. We operate through both performing credit and distressed credit. Mark said he's not a hotel expert. I would raise my hand. I'm not an hotel expert as well. I'm just a pure investor, yield buyer. We focus as a firm on a variety of asset classes, everything spanning from residential mortgage, non-performing loans, office, credit cards, ships, whatever we can buy in a loan format. Why hotels? Hotels, amongst the asset classes that we've been looking at, is one of great interest to us for a variety of reasons that we can explore more in detail later, but in particular for the positive correlation to macro trends, obviously the increased correlation thanks to high operating leverage, and finally the ability and the plentiness of distressed loans that there are out there in the hotel space. In fact, we recently have been announced as successful in acquiring a substantial portfolio of hotels through a loan acquisition in Britain of 4 stars independently branded hotels.
Thank you very much. And just to kick the conversation off, I think, Mark, it'd be great if you could give us some data points. Hotels have become and continue to become a leading asset class within alternative real estate. And that is something that has continued to evolve over, frankly, the last decade. And you have some interesting insights with regards to that from a data standpoint.
Yeah, so the markets that we cover reasonably well, Europe, the US, and Asia Pacific, which is quite heavily skewed towards Australia, the more mature real estate market. We see some different things going on over the years. Europe, we see some very strong outperformance by hotels over the last 10 years, and we do see that as being quite consistent outperformance and also less volatile performance. So in the very good years, pre-global financial crisis, we saw hotels performing well, but not quite as well at the peak as the rest of the property market. But we didn't see such heavy capital losses in the downturn. Hotels recovered more quickly and have outperformed over the last 3 years when we're looking at the rest of property as a whole. In Asia, that is not quite the same. There is outperformance, but there is more volatility there. So we do see more on the downside through the global financial crisis in hotels, but we've seen a much stronger rebound in places like Hong Kong, Singapore, and Australia over the last few years. In the US, apart from the hugely strong residential investment market that we've seen over the last few years, hotels has outperformed the standard sectors there, so the retail, office, industrial sectors that most institutions would consider core real estate.
When you look at hotels as an asset class in Europe, where does it perform against other commercial real estate from a returns perspective?
So over the last 3 years, we're looking at kind of a 7% return. This is up to up to end of 2012, so we haven't got all our results in for 2013 yet. Real estate is a very slow reporting and non-transparent asset class. Yeah, we've seen up to 2012 returns of about 7% in Europe, returns more in the vicinity of kind of 10% in Asia Pacific, and similar in US, which is maybe a couple of percentage points above the rest of real estate in those markets.
Okay. And Fabio, you touched on your current investments and interests. I believe your focus is the UK and some other continental European markets. What is driving because you are building your interest in this sector as an asset class, and it would be great to understand what's driving that. And then maybe, Renaud, you could comment on how that relates to the redefinition of Accor as a business and the interplay that there may be between those two perspectives.
Sure. So we very much focus on the Anglo-Saxon markets. As I said, we are distressed buyers, so usually we buy things through loan to own, and therefore, in order to implement such a strategy, you need to operate in markets where restructuring and loan to own conversions are efficient, and UK is the most efficient market in Europe for doing such a thing. In addition to that, we also like the macro prospects. So why hotels as opposed to other things? Well, first of all, we very much, in particular for regional hotels outside of London, we feel that there is the market has not yet picked up as opposed to perhaps city centers. So we like the macro play that comes with. As I said, as you all know, hotels are highly operationally levered. Therefore, in a positive macro environment, the outperformance is much higher. For example, in UK, we see a RevPAR correlation to GDP growth of 1.6, 1.7 times. So that obviously gives you a boost. In addition, from a pure technical perspective, the supply of new assets is fairly limited. The supply of funding on the flip side from banks has been pretty aggressive. We're seeing terms offered by banks which are beyond what we would expect or what we could have seen just 6 to 12 months ago. And in addition to that for us, it's an interesting play to add on additional things through other single asset acquisitions. So it's a fairly scalable platform, again, due to the operationally levered nature. When I look at UK versus other markets, Ireland is obviously a market where we're spending time. However, it's still in its infancy for hotels. It's much more developed in other asset classes like offices, like retail, like family, multifamily. And then another market, it's obviously in the Netherlands, which is a fairly distressed market, where we are very active in the office space, and we're seeing office to hotel conversion becoming more and more interesting. With regards to Accor, I think my neighbor here, it would be more appropriate for him to answer the question than me.
Before I jump into the Accor points, piggybacking on your points, Mark, I mean, the way I look at the hotel sector, I mean, first of all, it's a niche industry. So any niche is prone to some very attractive arbitrage opportunity. It's, it's less transparent, there is less liquidity, and hence there is more upside. There is also more downside. Second, when you look at the total returns, in fact, the stats which you guys produce in simplistic ways, the way I look at it, I mean, you said that there is about 200 bips spread between the total returns from hotel sector versus the other commercial real estate sector. I had more in mind like 150 bips over a 10-year period. And that's for Europe. So that's the second point with respect to the attractiveness of the hotel sector as an investment opportunity. greater spreads, obviously greater risk. The other thing is that most of the statistics available in the market are based on leasing. There is very few data available on hotels being sold on a management contract basis. And as we all know in this room, returns and yields are greater in a management contract versus a leasing contract. So probably the spreads between the returns you get in the hospitality sector as an industry versus the commercial real estate sector are much, much greater than that. So having given kind of the landscape, at Accor, we have had a asset-light strategy as we wanted to transform our company into a pure operating business. We all know that from 2005 until effectively the end of this year, or I would say November of past year, until Sébastien Bazin made his presentations to the investors, our focus was very much into becoming an asset-light company. And there was and there still is a lot of appetite for our hotels because it's substantiated by the strength of our brand, our distribution, etc. But also because some of the assets we were selling were, I would say, in the private equity world, I would term them as value-add type of investments. Effectively, hotels which needed significant CapEx investments, which Accor, for a number of reasons throughout its life, was not able to fund. And so was trying actually to outsource the CapEx requirements to its investors. Having said that, Accor being listed and being quite closely followed by a number of analysts and investors, Accor was under a lot of pressure to execute its asset-light strategy. And in the words of Sébastien Bazin himself, we kind of put ourselves in some sort of a corner of a forced seller. So we decided to get out of that position, and we decided to be transparent about it. And we communicated on the 27th of November that we would actually keep on selling assets, but we are going to restructure them first. And so effectively, we're going to get out of the timing constraints and the announcements which we had made before. We had said that we would be selling like 800 hotels over the next, by the end of 2016. We would be making 2 billion euros of sales proceeds out of those sales, that we had 600 million euros of cash available to get out of our leases. So we thanks to our communication and presentations, we got out of that position. And we are now taking the time to look at all our assets very carefully. We have, out of the 3,600 hotels I mentioned earlier, 1,400 are either owned or leased. We are looking at them very carefully. We are, for those which need significant capex, we are contemplating doing those capex ourselves. And then, and maybe, we will sell them back to the market, depending on market conditions, etc. But the view of Hotel Invest, which is again the investor and developing arm of Accor, is effectively to build a stock of hotels which should provide attractive returns going forward. I don't know whether some of you were at the CEO panel this morning, but Sébastien Bazin himself said that on the servicing side of Accor, we were very good. In fact, possibly better than most of our competitors in terms of margins, returns. And he also said that on the investor/developer side, at the moment, we were not that good. We needed to improve. And so, again, it's a long-winded answer to your question, but rather than outsourcing all this opportunity and this value to the private equity guys or the institutional guys or even high net worth people who have the ability to mostly restructure hotels, we are going to internalize that now. We're going to do it ourselves, and then we'll, depending on the market conditions, well, at the moment the view is that we keep those because we think they are great returns.
I think one point that should be said, and going back to what you just said, is as a distressed investor, obviously we are a discounted cash flow buyer. So we are bound by the cash flows that the portfolio generates, and that's true for most of the asset classes. So there is not much you can really do about it. So when you play in the office space, you might invest some capex, but it's kind of minor. And you're really bad on cap rate compression. That's not a bet we like to do. In the hotel space, operational improvement and operational effort, which is one thing that the Bain Capital family is renowned for, allows you to move beyond the pure cash flows of the portfolio and generate multiple accretion. So that's why when I look at returns of asset classes like other real estate, very dry real estate like retail, like industrial, like office, that's why I prefer hotels. They're much easier, paradoxically, to manage. They're more chunky type of assets. The operational component is more important. The risks are greater, and therefore the returns are also higher. And as a yield buyer, to our LPs, we have to deliver 20s type of returns. And that is the asset class that allows us to deliver that without taking overdue distress risk that you would take otherwise in trading in CMBS or other more distressed asset classes.
Yeah. Can I ask a question?
Yes, please.
Earlier you mentioned
Could I just ask for your name and just as an introduction?
Rick Solway from UI. Earlier you mentioned you were seeing a lot of lending. It sounds a little aggressive. Are you suggesting that you see down the road in a few years another bout of distress? Or is it simply that the capital is available, it's a good time to make use of it and deploy it?
I think, obviously I don't have a crystal ball. If I were, I would be a billionaire. But in terms of lending, we're seeing banks coming back to the market. I think the lending is aggressive in that the spreads are quite tight, but the LTVs are not that aggressive. We're seeing LTVs which are fairly conservative. In addition, if you think that we are at somewhat trough of the market, you would expect the LTV to be super conservative on a long-term cycle. However, we are seeing level of aggressiveness much more beyond that in other asset classes such as offices, such as industrial. The aggressiveness also comes because people are lending heavily on assets, but also lending heavily on portfolio. As you all know, there are probably 70, 80 billion worth of loans being traded on the market as we speak. And a lot of the lending is loan-on-loan lending, which also is not purely driven by the underlying quality of the assets, but is also driven by the creditworthiness of the investor, i.e. of the fund, because frequently there is some sort of recourse back to the fund. So all in all, I don't think we're yet, when we look at the peak of the previous cycle, we are not there yet in terms of LTVs. Spreads, we are fastly approaching that. And in the corporate space, we already are at spreads akin to what we saw before. But if it continues like this over the next 6 to 12 months, you might start seeing the effects of a bubble. And in certain markets, you already see it, like the London market. I would say that we are fully priced out of the London market, maybe Frankfurt as well. That's why we tend to focus more on regional markets. So in certain asset classes, yes. Certain markets, yes. The others, not yet. But if it continues like this, you might start seeing the effects of it, which is great for us because it gives us product to buy in a few years.
Has anyone else got any other perspective in the audience that they, yeah, please?
My name is Carlos Sonquillo from the Spanish Family Office. I've not said that there's not much data concerning managed hotels. To which extent do you think that a managed hotel is in a less favorable position than a leased hotel for a real estate investor?
It's an interesting perspective, the question. I was just going to come in because of what you were saying about managed hotels. I mean, and I'll give an example right now for what we are looking at from investors' perspective. Meininger is a hotel company which leases hotels. We have 16 hotels, all leased, 20-year fixed-term leases, with index-only situations. And so it's an operating company. And just to go back a little bit in terms of the whole debate about institutional investors coming into this market, and you said 10 years ago this wouldn't have taken place. I think what really happened was what Accor is doing, talking about right now, is going from asset-heavy strategy to an asset-light strategy. And when that started with Intercontinental and with Marriott splitting into Marriott and Host Marriott. So the operating companies decided they wanted to operate and not own assets. And that was a significant change in the hotel industry 10 years ago or 9 years ago. And that brought private equity into it, institutional investors into it. And so there's a debate now about whether they should own operating hotels or leased assets. Because obviously when you take operating hotels, you get a higher return because you take the operating risk. So it's a higher risk and higher return. You take the operating risk. And obviously it's to the extent that the operating risk is managed by a brand such as Accor or Intercontinental. For institutional investor, that's de-risking it to the extent there's a large brand out there. So those are the kind of elements that go into it. But coming from a brand like Meininger, let's say, a small brand, growing very fast, I also believe that hotels should be in the asset-light category because operating hotels is an operating business. It's not real estate. And therefore, we have an aggressive growth strategy in Meininger to grow from 16 hotels that we have now to over 50 in the next 5 years. We are leasing assets. We are converting offices into hotels. Our last hotel I mentioned was a brewery converted to a hotel. And we find a lot of opportunities, like in Holland, you mentioned there are office buildings available for conversion. So conversion is one aspect of, if you can convert into a hotel asset, you are able to generate superior returns because the office market currently, like in Holland or in Spain, is got spare capacity. So, but you need the kind of product, flexible product to do that. Most hotel companies can't do that. Everything is generally quite prescriptive. It's got to be a hotel which is fixed in nature, 2 beds, a bathroom, corridor. It's not easy for most hotel companies to be able to deliver that. So in the case of Meininger, we have a flexible product which can convert an office building, a brewery. Since we have multi-bedded rooms, we can go anywhere and convert almost anything, provided there are window spaces available. Mm-hmm. So if you have the right product, you can do that. But in most cases, hotels can't do conversions that easily. When it comes to leases versus management contracts, the question you were raising, we decided we wanted to grow fast, so we can't always get leases in locations like Paris or London, which are difficult to enter. So we have created a fund, a property fund, which we are actually about to raise, 200 million euros, to buy assets owned by pension funds and lease it to Meininger. And the question was, what kind of structure should there be between the operating company and this new 200 million euro fund that we are launching right now? And what turned out was what they want is a lease, because they don't want the operating risk. They want the yield, whatever it is, 7% or 6.5% or 8% for forward funding our projects that we want to do. They want to take the forward funding risk and get the higher return, but a fixed return, because they don't want the operating risk of how Meininger deals with running a hotel. And therefore, that de-risks it for them. But it's a fixed lease or a bit of a variable, so which can give some kind of a higher return with the variable. But it's not the same kind of return, probably with an operating risk, with an operating contract, but of course not volatile at all. So for a pension fund, institutional pension fund, a German pension fund, or a Dutch pension fund, give you 10-year money, fairly stable return of 7%, let's say, that's something attractive for them. And I think it competes well with the other classes that they're in, retail or offices.
And we would definitely see that with all of our institutional clients. They far prefer lease to lease the product. They don't want to get involved in an industry they don't understand. So separating out the operation and giving the investors in the real estate a steady income flow over the course of 5-10 years is definitely what the institutional investors want. And it takes a few years. Real estate's quite a slow beast. It takes a few years for people to get used to it, a new type of real estate. But we are seeing it increasing in the allocations of the big pension funds, insurance companies, etc.
Yeah, I mean, it comes down to risk appetite again, and every situation is different, trying to answer to your question. And it also comes down to the jurisdiction. As we know, German countries are not prone to management contracts, while other countries may be more so. And there are management contracts which you can destructure with the lease piece and the operating piece, which we have done, and I'm sure other operators or arbitrageurs in the hospitality sector have done. I guess the answer is more like you need to go back to the fundamentals of the hotel and the positioning, whether it's a brand or eco sector or mid-market. But I would argue that a big hotel, even in the eco sector or the mid-market sector, extremely well located in a gateway city, well, most people will tell you you should do a lease on it. Well, you could argue why not management? I mean, it comes down to what the operator also wants and what the investor wants. But extremely well located. I'm not going to quote any brands, but right in the center of Paris, more than 250 keys, if that existed. I mean, most people would tell you, do a lease. But in fact, why not do a management contract? Because the risk which the investor would take on such a hotel would not be that different in terms of cash flow risk than the one you would take as on a lease, on a variable lease, say. Because if the fundamentals of the hotels are great, the hotel is bound to operate well, whether in a good term or good times or bad times, and you could almost be cynical irrespective of the brand. And in fact, some banks, some lenders have, in fact, I can think of one famous German bank who is quite strong in the hospitality sector. It has very well understood that. And in fact, they only fund management contracts, but very specific type of hotels in management contracts. And they are not so keen on leases. Those who are more conservative and maybe who are not prepared or equipped to go deep into the matter, into understanding the fundamentals of the hotel, are more prone to lend against leases. And I would argue, no offense to the investors, but the institutions, we need them, a bit like them. They look at a great covenant from a big brand, portfolio of good hotels with strong leases, long-term, cash yielding. In fact, the mistake, I would say, they may make is not mistake, but they should look at it a bit differently. They think too much, or they adjust too much their risk policy to the type or the signature of the covenant rather than the key fundamentals of the hotel. So
that's a key point. That's a key point in terms of the coverage, if you like, the underlying business. If the underlying business is has a problem, then if it's too high a lease, and that's what's happened in Europe, and I'm sure that's the examples you're referring to, where hotels in the mid 2005, 2006 might have leased at very high levels of rent, and hotels are cyclical, more cyclical than perhaps other businesses, and certainly at the higher end of the market, perhaps even more cyclical when they depend on business cycles rather than just leisure. So with the cyclicality, as the cycle goes down and if the rent is fixed, right, and it's maybe indexed only and going upwards, even though inflation is quite low, you have defaults. And that's what's really happened and created a huge problem. So the coverage ratio is really important, I think, as to how much you can cover it with, and also what's your business model which supports that particular situation. If it's purely dependent on a business market, which is highly susceptible to business cycle, and also you rented at very high yield for whatever reason, because the market was strong. So the timing is quite important as well, I think. But I think certain markets, certain kinds of hotels, certainly at the budget end, and certainly at our end of the market, where our occupancy for the last 5 years average is 92% room occupancy, and will remain so because 60% of our business comes from groups, student groups, and other groups. So we have very little risk of economic downturns, and our rent coverage in our case is about 2.5 times rent of EBITDA. So if we did a sort of a scenario as to when we would stop paying rent, it would be around 38% occupancy or 40% occupancy. And when we start our business, we are starting at 50% from day one. And it's unlikely to depend on economic cycles, because you're catering to the student market or the education market, not the business market. So if you have that kind of a model, I think, and give a strong coverage in terms of your covenant. So I think completely agree. It's not just the top companies, the underlying business model which investors should look at. And I think in our case, that's what we find. They'd actually go deep down and look at that, and they get safety and cover from that point of view. So you're absolutely right. It's the actual business itself. And in many cases, that doesn't suit a hotel, a business hotel.
I agree with that. What kind of leverage would typically in the UK people put against such leases?
The market is quite strong in the UK, so we are talking about probably about 60%, but I would underwrite 50% if we were doing a deal for a lease.
For us, it's completely agnostic. We are completely indifferent whether it's leased, whether it's a management contract. It's all about yield. So.
Don't you care about the operating risk, employees,
we look
tax risk?
We look at risk reward, and obviously for a managed hotel, we'll look at a higher return as opposed to a leased hotel. But after all, there is a price for everything, right? So, so long as you're able to factor the various type of risks. For example, if it's a leased hotel, you look at what is the arbitrage you're doing versus the underlying credit risk of the operator, as opposed to, for example, if it's Accor, you look at what subs of Accor trade in the market, what kind of yield you get from the hotel, and you take a view whether that accounts for the liquidity risk you're taking over, and for the renewal risk that you have on the lease, as opposed to if it's managed contract, you have to factor in the headaches, the various complexities that go with it for owning and operating a business. But after all, it's just a risk reward for us.
There was another far back. Yeah, thank you. I'll come to you in a second.
Good afternoon. Weldon Mathers, my name, independent hotel consultant in UK and Ireland. Questions for Fabio, just in relation to the hotel portfolio you've recently acquired through the wind down of IBRC. You mentioned that you're looking at more deals. I'd be interested to find out what were the motivations behind looking at that particular deal, and also there's talk that NAMA in the Irish Republic will be wound down well before the deadline of 2020. And given that they have 80 hotels on their books still, is that something that you'd look at to buy in one big package?
You're asking me to disclose the secret sauce, but basically there is no secret sauce. Why did we pick Q Hotels? Where it's a mixture of things. We looked at a lot of those. We very much like the corporate sector, and the reason why we like the corporate sector is because we thought we think we're right, is the more distressed and more late cycle versus other type of hotels versus leisure, for example. We looked at a lot of them in the past. We looked at Principal Haley, De Vere, and a bunch of others. We looked at a project East from Lloyd's that was trading in the market. So Q, we like the management. We think the management is exceptionally good. We very much like the asset distribution. We like the products. We also looked at some of the other assets, but we were not able to acquire those. The reason why we would like to increase and potentially augment the size of it is because, as I said, we think there is a positive macro. We think in most of the other assets they've been capex starved, and so the effects of it are kind of waning, and it's important that we pick the pieces as soon as possible and improve it. So if you sit here and wait for the next 24 months, then the cycle will play against you. As all of my colleagues here said, that it's a very cyclical industry. I can think of more cyclical industries than hotels, like shipping, for example, but within the real estate is probably the most subject to volatility. With regards to Ireland, we've been cautiously looking at the market there. Definitely the assets that we very much looked at the NAMA portfolio and a variety of different asset classes. The hotels that they have will be interesting. Obviously, NAMA runs wide auctions, and unless we have a proper angle, it's unlikely that we will be a strong participant on that. But yes, Irish market, I think after the UK one for distressed investors is probably the most appealing because of the very strong common law-based principles, very easy to do workout strategies. Another market where you have a similar approach is Netherlands, but it doesn't have the strong macro drivers that you can witness in UK and Ireland. And then definitely outside of NAMA, Spain is definitely a market that we've been we've been closely following and looking at. There are a variety of hotel portfolios being currently trading on the market, whether as part of bigger things or not. And again, Spain is not a market where the bankruptcy process is fairly straightforward, as opposed to maybe Italy or Portugal, and where the stress pipeline of hotels is pretty substantial.
The other thing, can I just?
Yeah, please.
I mean, I know from a debt point of view, the other thing I've experienced in my career, and I've been in private equity before running Meininger, where I was doing a joint venture between Intercontinental Hotels and the fund that I was involved with to build Holiday Inn Express. And the key thing that I've always found with dealing with investors looking at the hotels is what kind of period of investment they're looking at. And hotels tend to be longer term than other asset classes, particularly if you have development involved. So typically if you build a Holiday Inn Express, say in India, or any other place, you would take 2-3 years to develop the hotel, another couple of years to stabilize it. And therefore, you're talking about an 7-8 year investment horizon for the investor, and then he gets an exit. So from an investor class point of view, he's got to be patient in order to get a return, particularly if he's getting involved with greenfield development and not just acquiring an existing asset. So that plays a big role in terms of looking at different asset classes. Whereas if he's doing a residential building, a particular investor may get a return in 2 years in terms of whatever return he gets. So a big factor for hotel, the industry has been equity as to what kind of investor and what kind of longevity they have in terms of their profile. And so there's been a big struggle between private equity who wants a 5-year exit versus patient investor who wants a 10-year return. So that's a big conflict that the hotel industry always finds itself in terms of what kind of length of investment is, how patient the investor is. Because if he's less than patient, then you have a problem, you have a conflict.
Buying Express, obviously you generate returns partially from a workout, so that already takes you to a certain level, and then through the restructuring and financial engineering of the portfolio, so that allows you to take your money off the table and also to be more patient. We have, as most of the other distressed investors, who have a 7+2 years fund, so I think we have a pretty long investment horizon, but probably as opposed to maybe other more institutionalized investors we need to be very hard pressed in order to keep the investment for beyond a certain period of time, because every year it's a 20% tick, and so the macro and the drivers have to be pretty strong in order to compel us to hold the investment.
Yeah, I mean, it's true. I mean, in our asset-light strategy, when we sell our hotels or sold our hotels, I mean, one key criteria was the commitment of the owner, of the buyer, to the long-term relationship, and that's no vain words. For example, last year we sold the Sofitel, our flagship hotel in Paris, Rue Boissy d'Anglas, between the Crillon and the American Embassy. And we've been looking for long-term committed, patient investors who are there for the long run, rather than private equity people who would be more inclined to flip the asset. Because each time the asset gets traded, you are facing a new owner, and then the new owner may have a different policy. So if you haven't properly structured your management contract, the clauses in the management contract, you may be on the hook or taken hostage of the new trader. So this is something I mean, the nature and the philosophy of the investors is very, very important to us, and that goes the same when we implement our franchise strategy in all the key European countries.
And I think it's about education. It's about educating the big institutions about what hotels is. If you think that institutions are looking at real estate as being 5 or 10% of their investment allocation, and hotels is a small part of that, to get them to dig down and understand, that's quite a detail for them. They might find that when they do, there are good returns to be had. But that's why I think as an industry, the hotel investment industry needs to be continuing to educate the large investors as to what the hotel investment is about and what it will return for them.
I think that's where you guys
Well,
can help a lot.
Yeah, we're trying. Yeah, and we'll keep trying.
Great. We had a question over here.
My name is Habib Anatullah with Hilton Worldwide. I had a question with regard to Navneet. When you're doing the lease deal, the sandwich leases, I guess, you're taking a view on the market over a long period of time. And I guess the question is, what happens if the market doesn't turn out the way you expect it to? If you have an RPI or a CPI-ing lease obligation, how do you work out the deal at the end of the day, or how are investors perceiving that risk, let's say 7, 8 years down the road? I mean, this is something that's happened repeated in provincial UK. I mean, we have personal experience on our end as well, where, you know, when the leases were done, they were RPI'd, but the underlying business did not grow at an RPI level.
It's a good question. So that's my earlier discussion point was that you've got to look at the market, the underlying market that you're addressing. In our case, in the case of Meininger, our business model is focused on student groups coming on school trips, and 50% of our business is school groups. And so therefore, and in fact, anecdotally, last 3 years we've had the first sort of times, if you like, in Europe. And you know, students travel because they go for education, and the school trips take place regardless of the recession. So in a sense, I would say our model is quite recession-proof, because you have it's based on education travel. 50% of our business is school groups, so that hasn't affected us in the last 3 years. The last 3 years, our average occupancy, bed occupancy, and we measure bed occupancy because underlying it's a hostel inside a hotel, is about 74% on the average last 3 years, which translates into over 90% room occupancy. So right through, so I think the worst of times we've seen that. But some of our hotels are more prone to business cycles because they're located, for example, Frankfurt. We have a hotel near the convention center, which is more business focused because of the Messe and the convention center there. So I would say, yes, that will be more prone to some kind of a business cycle because you have, you know, if 1 or 2 conventions drop off because the business cycle changes. But essentially, our focus has been on developing a model where we can deliver a high proportion of our business upfront from a market which is not prone to business cycles. And therefore, we can afford to look at a lease over a long period of time because it's, you know, less susceptible, effectively. So I think in a provincial market like in the UK, if you have a lease and it's very susceptible to the cyclicality, then you have a problem. I mean, in terms of the way it's structured, particularly if it's a fixed lease and not, you know, linked to revenue or GOP. So I think you've got to vary the structure based on the underlying market. That's essentially
where you put the effort rate, doesn't it? I mean, it comes down to also where the seller, in which position the seller is. You need to take a business view, but also as a math computation, right? If you want to maximize the sell price, you are more likely to put a very strong effort rate, and then you may pay it later when down cycle. So if you want to take a perspective on things and long-term view, you are more inclined to, I think, have a lower, as I'm sure everyone knows this in the room, put a lower effort rate on your lease. When you sell your assets, you obviously won't get as much as you would expect, but on the cash flow, at least you're taking less risk. That's on fixed leases or IPI indexed. I think in the UK, there are not that many variable leases. In France, there are quite a few. And you could argue that with variable leases, it's also a way to mitigate that, although you are then exposed still to cyclicality. The other point on leases, though, is that as we have found out, you tend to lose control of your assets, especially if you do complicated structured with special clauses, minimum guarantees, clawbacks, etc. And unless you have a strong asset management team in your organization, you may end up in situations where you actually don't really know anymore what is in which relationship you stand with your owner, and then you are up also for trouble. So it's not only a question of just cash flow, but it's also a question of effectively managing the hardcore of the hotel, the capex, the maintenance of the hotel, which are all to be considered.
We've got about 5 more minutes left. Have we got any more questions from anyone in the audience?
Hi, Macy Marvel. I'm from Geneva, but I represent Mintel International here, which is a London-based commercial publisher. I have a question, 2 questions for Renaud. First of all, don't you think you're going to lose market share in Germany by the fact that you won't do any more leases, as your CEO told us this morning? And second of all, could you just give us an idea of the structure of your turnover lease contracts? What are the sort of average percentages, and are there minimum guarantees typically?
Market share in Germany, I'm not sure I'm able to comment on that. Of course, when the group made the decision to not do any leases going forward on new projects, we were fully aware that this would impact 2 key markets, one the German and the second the UK. I don't have an answer to your question. My view is that there are other ways. Maybe we will focus more on franchise contracts than just pure leases. But I agree with you, it's going to be it's a big challenge for our German team. When we say we don't do any leases in Germany anymore, or we don't do any leases again going forward, this is not quite correct. In fact, we don't do any new leases, but the lease is in place. We can still keep. We are not going to necessarily buy them back. We are going to try to restructure them. But you could argue that your statement or the answer to your question could be positive. We will see. It's a tough one.
Can I just say one thing? If there's any owner out there who doesn't like an Accor lease, we're happy to lease.
Yeah, well, I mean, I'll give you a ballpark. It can go as low as 15% of rent and relatively higher than 20% of rent. And the term of, I see that Navneet is taking notes. No, I'm kidding. That's relatively long term, and we make sure that we keep the hand on the renewal option. Because some of the assets we want to keep, obviously we want to stay control of it. And then in terms of capex or maintenance conditions, I mean, I'm not going to be too transparent about that. I'm sorry.
Any more questions? So I think it's been a great conversation. Just to close up from each of the panelists, you've inferred during the conversation that institutional investors are missing opportunities in this space. That the cycle is moving very, very rapidly at this point in time, particularly in key markets. Principally, the UK has been the reference point, but I think that extends into other markets across Europe. And it'd be good to close on just each of your viewpoint on the outlook for hotels as an asset class, not in isolation, but also relative to real estate as a whole. And maybe, Mark, you could start on that point.
Yep. So one thing we never do is forecast, so I'm not going to forecast any numbers, but I would just simply say when I talk to the biggest sovereign wealth funds in the world and they see the real estate world as retail, office, industrial, residential, hotels, that tells you something about where some of the largest sources of capital are putting hotels on a relatively level playing field with the rest of the real estate world. I think then smaller institutional funds will then follow.
So really establishing itself as a standalone asset class.
Yep, which it has done more so in the US and Australia. I think we'll see that happen more in Europe.
Daphne?
I think I agree with Mark. Last 10 years, the changes that have taken place in the industry, as we've talked about, have encouraged institutional investors, large pension funds, government-owned sovereign funds to get into this market. And with that coming in, and the kind of data that's being produced transparently now, is greatly helping people to understand. I mean, Mark's recent report, which I read with great interest over the last few days, indicates that there's in the last 10 years, hotels have done better than the other asset classes. And that sort of information being available to institutional investors would greatly help the hotel years cause, if you like. For example, in a place like, from emerging markets like India and so on and so forth, there's very little data available yet on what kind of returns you'd get. So it's very anecdotal. And as it becomes more transparent and the market focuses on real hard data, I think it will help what we are talking about in terms of future allocation, if you like, between assets towards the hotel sector. So I certainly think that's a positive development.
Bruno, I know you've spent a lot of time as an organisation getting out of the time constraints that were previously set, but where do you see the market in the future and relative to Accor, to the extent you?
Yeah, I think there's value creation to be made. There is a significant upside if you do the things right. I mean, when you step back, look at, it's all a question also of opportunity cost, right? And so look at where government bonds are, look at what the yields you get on a prime office, look at the spread differential. It's probably like in key cities, government bonds are like, 10-year bonds are like at 2%. Prime office is below 5, if not before 4.5 yield. In hotels, you can do much, much better than that, and you will still be doing much better than that. And I think at Accor we will do even better because we are starting from a lower base in terms of return on capital employed today because of what I explained earlier. We're working on the assets, reinvesting into them, renovating them, and getting ourselves better organized. So the outlook and the perspective on hospitality in general, in my view, the macro view is quite exciting. And in Accor, we want to take advantage of it. The other thing, and I'm sure investors realize it's a great inflation edge. We all know that real estate is a great one, but hospitality is even more so. Sure, there is more cyclicality in it, but definitely we do very well in inflation, and we hedge ourselves extremely well against inflation. And if we believe that inflation will be back up soon, well, it's a good investment window to take advantage of. So personally and as a group, we are quite positive about it. We will see where we stand at Accor once we have restructured our Hotel Invest business units, which, like you mentioned, we are not under time constraint anymore, so we will see.
Thank you. Fabio, institutional investors, missing opportunities?
Thank you for calling me an institutional investor. People
no,
usually call me worse names.
You're taking advantage of them.
People use different names for me. But for us, it's 5 points for us. I mean, as a distressed investor, we see positive macro trends. So the appeal of hotels is in so much as the macro performs. So obviously we see UK a strong place, Ireland fastly coming up, Southern European countries slightly more difficult, but yes, the macro seems more positive. Depending on what's going to happen in Ukraine is not having massive impacts on the bond market, but let's see how that pans out. If I look at the US as a comparison versus Europe, the US hotel cycle has overperformed and performed much faster and much more aggressively than what people were expecting. My personal perspective is that, particularly in the UK, we'll be surprised on the upside. So that's why our urgency to deploy capital as quickly as possible, capital both in the terms of buying and in terms of spending capex. When I compare it to other asset classes, we're excited about hotels and student housing and nursing homes. Again, heavy operational component where somebody sitting in a room and trading on Bloomberg cannot compete against us. But it's, roll up your sleeve and try to understand what you're doing. We also see from a technical perspective ability of banks to deploy capital much more aggressively than you would have seen before, and also appetite, which we're trying to understand whether there is real appetite or not for REITs, hotel REITs in the UK market, which is obviously very important for us for exiting our investments. And then we also see the opportunity as a value play. As I mentioned before, if we could buy leases, hotel lease to somebody like Accor, the subs of Accor trade at 2.5. The lease trades at low teens. It's a no-brainer for us because we can short the CDS and get risk-free. And that we think accounts for more than enough of the liquidity or lack of premium. So overall, we have a very positive view. We're open for business, and I'm not kind of reinventing the wheel. I think a lot of my competitors are taking very similar views.
Well, hugely positive, I think, outlook across the panel, which is clearly pleasing to hear. We are slightly over time, so I will just now close. Thank the panel, and also I'd like to thank the audience because it's been great to have questions through the session rather than just a few at the end. So thank you very much for that.